You did everything right. You worked hard. You saved in your 401k. You retired careful. And then one day, you pull a little extra from your IRA, and the IRS reaches over and taxes your Social Security too, at a rate higher than you ever expected. That, my friend, is the tax torpedo, and it hits the good savers hardest. I'm Ray. Folks call me Uncle Ray. I spent my whole career as an accountant, and now I'm retired myself. Today, I'll show you three things: what the tax torpedo actually is, why it ambushes careful retirees, and, stay to the end, the one move that diffuses it. Quick note: I'm a retired accountant explaining the public rules in plain English. This is education, not financial advice. For your own numbers, sit down with your own CPA. All right, let's get into it. So let's start with the one idea that runs this whole thing. Whether your Social Security gets taxed does not depend on the size of your Social Security check. It depends on a special number the IRS builds. It's called your combined income. Here's the formula, and it's simpler than it sounds. Take all your other income, your IRA withdrawals, your pension, any interest, and then add half of your Social Security. That total is your combined income. Let me say that a plainer way. Imagine the government adding up everything else you live on for the year, and then tossing in half of your Social Security on top. That one number is the dial. The higher that dial goes, the more of your Social Security gets pulled onto your tax return. So it's not your benefit that's the problem. It's how much other money you're bringing in around it. Now, how high can that dial go before the tax kicks in? There are two lines to know. I'll use a married couple filing jointly. Below $32,000 of combined income, none of your Social Security is taxed. Between $32,000 and $44,000, up to half of your benefit can become taxable. And above $44,000, up to 85% of it can be taxed. If you're single, the lines are lower, $25,000 and $34,000. Let me put that in plain terms. Think of it like three zones. In the green zone, your Social Security rides tax-free. In the yellow zone, the taxman takes a bite. And in the red zone, up to 85 cents of every benefit dollar is exposed to tax. And here's the quiet part. Those lines are low. It doesn't take a fortune to cross them. A modest pension and a few withdrawals, and a lot of ordinary retirees are already standing in the yellow or the red. Okay, now the torpedo itself. This is the part almost nobody sees coming. When you're in that middle zone, something sneaky happens. Every extra dollar you pull from your IRA doesn't just get taxed on its own. It also drags more of your Social Security into being taxable at the same time. Let me show you why that stings. You take out $1. That dollar is taxable. Fine. But that same dollar just made, say, another 85 cents of your Social Security taxable too. So now you're paying tax on $1.85 from pulling out a single dollar. Here's the plain English version. Picture a row of dominoes. You tip over $1 of withdrawal, and it knocks over a second domino, a chunk of your Social Security right behind it. One push, $2 taxed. The result? Your real tax rate on that money can jump way past your bracket. A retiree who thinks they're in the 12% bracket can actually be paying 22% or more. That hidden spike That's the tax torpedo. Now here's what makes me shake my head as an accountant. Those threshold lines, the 25,000, the 32,000, were written back in the 1980s and 90s, and they have never been adjusted for inflation. Not once. Let me put that in perspective. Everything else in the tax code creeps up with inflation each year. The brackets, the standard deduction. But these Social Security lines have been frozen in place for decades. So, think about what that means. When these rules were written, taxing Social Security was aimed at wealthier retirees. But because the lines never moved, while prices, pensions, and account balances kept rising, today they catch the ordinary middle-class retiree, the person who saved responsibly their whole life. That's the cruel irony of the torpedo. It doesn't punish the careless. It punishes the saver, the one who built up an IRA and now has to draw from it. Let me make this real with our friends Frank and Carol. This is just a hypothetical to show the shape of it. Frank and Carol are living on their Social Security and a modest IRA. They're sitting right in that middle zone. One year, they decide to pull an extra $1,000 from the IRA, maybe for a new roof. Watch what happens. That $1,000 is taxable, but it also pushes about $850 of their Social Security into being taxable. So the IRS now taxes them on roughly $1,850 from a $1,000 withdrawal. Their bracket says 12%, but on that roof money, they're really handing over closer to 22%. Same withdrawal, nearly double the tax. That's the torpedo in action. Real quick. If this is opening your eyes, do me a favor and hit subscribe. It helps me reach another retiree about to step on this landmine. Okay, so how do you defuse it? Here's the good news. The torpedo can be diffused if you plan ahead. Let me give you the big levers in plain terms. First, Roth accounts. Money you pull from a Roth does not count in that combined income formula. So Roth dollars slip past the torpedo untouched. Second, Roth conversions in your low-income years. Early in retirement, before Social Security and required withdrawals kick in, your income is often low. Moving money into a Roth then can shrink the future IRA that would have triggered the torpedo later. Third, the order you spend matters. Sometimes spending from savings first and delaying Social Security keeps that dial low in the dangerous years. Let me boil it down. The torpedo lives in one number, your combined income. Control that number, and you control the torpedo. Quick recap. Your Social Security is taxed based on your other income. In the middle zone, each extra dollar drags your benefit into tax too. Those lines are frozen, so more of us get caught every year. And Roth planning is your best defense. Now, what retirement tax scares you most? Drop it in the comments and send this to your spouse. Next, I'll show you exactly how Roth conversions work. The move that quietly saves careful retirees a fortune. This is Uncle Ray. Take care, and I'll see you in the next one.